Your credit score might be the one number that is silently controlling your life. And most people don't even know what that really means. 3 digits, that's it. Those three numbers, those can decide if you drive off the lot in a car that you just got approved for, or get told that we're going to call you back later. And we know how that goes, right? Three numbers that can decide if you get the keys to your first home, or if you get denied and you get told that you have to keep renting or rent a home. And here's the scary part. Most people don't actually know what a credit score is. They think it's something that is calculated randomly, or they may think that it's about how much money they make, when income has nothing to do with your credit score. They think that it's just about paying bills on time, and that's not accurate either, not even close. My name is Calvin Russell, and I'm a certified FICO professional and a licensed real estate agent. I've helped thousands of people just like you nationwide not only increase their credit scores, but help them accomplish their credit goals. Okay. Now, by the end of this video, you're going to know exactly and understand what a credit score is, why it matters so much, and how it has so much control in your life, and how it can either unlock doors or quietly keep them closed. Because once you see how all of this works, you'll never look at those three numbers the same way again. Now, let me paint a picture for you. You've probably experienced this as well too, or you may know someone that has experienced this. You apply for something, whether it's an auto loan, a credit card, an apartment, and you feel good because you fill out the application, you may have a good job, and you say, you know what, I should be good, right? You make decent money, you've been responsible, but then the response comes back and it says, based on your credit profile, that's the moment that everything changes. And here's why this matters so much. Let's go into number one. Your credit score is not about how good of a person that you are. Now, when credit scoring first started, or right before credit scoring, they used to go off of referrals and, references and, how did you do with certain other things? But with this, it's a little bit different. It's also not about how hard you work. It's a risk score. That's it. A credit score is a number that tells lenders how risky it might be to lend you money. The most widely used scoring model is created by Fair Isaac Corporation. Now, you may know this as FICO, F-I-C-O, or the FICO score. Now, the FICO score ranges from 300 to 850. That's the highest you can go. The higher the number, the lower your risk. But here's what most people misunderstand. Your credit score is not based on your income. It's not based on how much money you have saved. It's not even based on how much cash that you have. It's based on your behavior. So let me show you what that means so you all can get a better idea. I'll give you a scenario. Let's imagine that there are two people. Person A, they make $40,000 a year. Now, person B, they make $120,000 a year. Now, when you hear that, you think that person B automatically has better credit because they have a higher income. That is not true. Sometimes we'll call that broke at a higher level, and you'll see why. If person A pays on time, they keep their balances low, they manage their accounts well, their credit score can be higher than person B's. Why? Because credit scores, they reward your pattern, okay? And this is where people get stuck. They think, I don't make enough money yet, so I'll worry about credit later. You don't want to do that. As a matter of fact, that's backwards thinking. Credit is built long before you even need it. And if you wait until you need it, it may already be too late because now you've already gone past past 18. You're now in your 20s, maybe even 30s. Now let's talk about why this number matters so much. First is going to be interest rates. Now let's say that you are buying a car. With a high credit score, you might get 5%, maybe 0%, somewhere in that range. With a low credit score, you might get 18%. Now that alone, that difference can cost you thousands of dollars. We're talking the same car, the same price, very different monthly payment. But now let's change the scenario. Let's say that you're buying a home. A small shift in your credit score could mean paying tens of thousands of dollars more over the life of a mortgage. That's not small money. That's life-changing money. And here's something that a lot of people still don't realize. Your credit score can even affect not just your auto loan, home loans. We're talking insurance rates, apartment approvals, utility deposits, and sometimes even job opportunities. Yes, companies do look at your credit scores depending on where you're applying. That's why this matters. Now, I want to open up another scenario. Later in this video, I'm going to explain the one part of your credit score that a lot of people ignore, but it can swing your score fast. And when you understand it, things will start to click for you. But first, let me break down what actually makes up your credit score, because some people don't know this. There are 5 main factors that make up your credit score. Number 1 is going to be payment history. That's 35%. Amounts owed is going to be 30%. Then you have length of credit history. That's 15%. New credit and credit mix. Those are both 10% each. Now, payment history is going to be the biggest piece. 35% of what makes your score is going to come from payment history alone. This is very simple. Did you pay on time? If you didn't, you need to know this. One late payment can hurt you more than most people expect. And here's what I see all the time. Someone misses a payment by 30 days, their credit score drops 60, 80, sometimes 100 points. That's why consistency matters more than intensity, okay? It doesn't matter what you want to do or all the rest of these things. You got to make sure that things are paid on time. Next is going to be the amounts owed. This is where that hidden factor is going to live. This is called utilization. Now, that's how much of your available credit you're using. If you have $1,000 credit card and your balance is $900, you're using 90%. Even if you pay on time, that high usage, it can easily drag your credit score down. This is the part that people ignore. They say, but I pay it off every month. Don't get me wrong. That's good because you obviously have debt and you're paying the debt off. But if the balance reports high before you pay it off, your credit score is still going to drop. I've seen people gain 40, 60, or even 100 points just by lowering their utilization. No new accounts, no tricks, no hacks, just strategy. And we talk about strategies just like this in my private credit community. We go deep, okay? This is for people who are serious about improving their credit scores, qualifying for homeownership, or even lowering their car payments. If that's you, you can scan the QR code or click the link in the description to learn more. Now, let me tell you about someone that I work with. She wanted to buy her first home, and her credit score, it was stuck in the low 600s. She didn't know what to do. She tried a lot of things. She tried to dispute things, and the score just wouldn't move. She thought that she needed to wait a year. But when we looked at her report, the real issue wasn't late payments. For her specifically, it was high credit card balances. We created a simple payoff strategy. Within a few months, her credit score went up over 700. She had the same income, because some people think they need to make more money. She had the same job, okay, but a different credit score, which created different options. And if you're watching this thinking that, well, I don't know what my specific plan should be, that's exactly why we offer a custom game plan. Now, this is where my team, they review your credit report and they look at your credit goals and they build a personalized strategy just for you. Now, if you want that, scan the QR code right here on your screen or click the link in the description below. Because guessing, you don't want to keep guessing with your credit. Guessing is expensive. Strategy saves you money. And if this is helping you and you want more videos like this, be sure to subscribe today. Now, here's the part about all of this that surprises a lot of people, and that's going to be the length of your credit history. A lot of people close old credit cards thinking that it's going to help them. Now, sometimes it does hurt, okay? Older accounts show stability. They show that you've managed credit over time, that you're not just a flash in the frying pan, that you've learned how to do something and you continue to do it. Now, another factor is called new credit. Every time that you apply for something, there could be a hard inquiry. Too many of those hard inquiries in a short time, it can signal some risk. And then, of course, you have what they call credit mix. Having only one type of account versus a mix of revolving and installment accounts can make a huge difference. Now, let's break down revolving and installment really quick. Revolving accounts are accounts in which the amount that you owe, it essentially revolves, okay? That means that what you owe, it can change. You swipe for $100, you pay $100. You swipe for $200, you pay $50, and now you owe $150. So again, it revolves. Then you have installment accounts. Installment accounts usually end in the word loan. That means personal loan, student loan, auto loan, mortgage loan. Those are going to be installment accounts. Also, credit builder loans as well. So when we say a good credit mix, that's what we're talking about. And that can make a huge difference. So let me bring this back to the big idea. Your credit score is a reputation score. It tells a story about how you handled borrowed money. Okay. And whether you realize it or not, that story is being read all the time, whether you're applying or not applying, because companies do soft pulls on you too. Now, remember what we talked about before, that fast thing that can happen that can change your credit score. That's going to be utilization. This is where you can see movement quicker almost anywhere else. It's not overnight magic, but it is something that you can easily throw money at and start seeing results. We're talking measurable change. Now, here's the empowering part. The system is not random. It's very predictable. And when you understand the rules, you can play the game better. So now, if you haven't been taking notes, you need to take notes right now, because I'm about to give you a recap, okay? Number one, your credit score is a risk score. It ranges from 300 to 850, and it's based on behavior, not income. A lot of people keep thinking that your income has nothing to do with it. Payment history matters most at 35%. Utilization, or amounts owed, can move your score fast. That makes up 30%. Credit length history is 15%. New credit and your credit mix are going to be 10%, and they all play a role. Now, here's the real consequence. If you ignore this, you will pay higher interest. You will have higher monthly payments. You will have to always give a deposit, and you're going to hear the word no more than yes. But when you manage it well, you're going to get lower interest rates. You're going to get more approvals. You're going to have more options, and that's going to give you more control. So here's my question to you. What do you think is currently holding your credit score back the most right now? Is it late payments? Could it be those high balances that we talked about? Could it be too many recent inquiries? Or if you're not sure, let us know inside the comment section below. Because once you finally identify the real issue, that's when you can fix it. And listen, if you like this video, you're most definitely going to love the next one, and I'll see you there.